Good afternoon, everyone. Welcome to today's weekly market insights. Now, as we have a come across to the calendar, have a look at what has gone on this week. This was a week of central bank announcements. Now, we did have some employment, some labour market figures out of the UK on Tuesday. Not really much out of them, to be fair. The main focus of attention was on the Fed on Wednesday and the Bank of England yesterday on Thursday. We also had the Bank of Japan. Monetary policy settings in Japan unchanged. They keep their benchmark. They keep the interest rate minus 0.1%, short-term rate 0.1%, minus 0.1%, and they keep the 10-year yield anchored at 0%. So not much change there, which is as expected. Now, as we come across to the Fed, the Fed with Jerome Powell has opened the door to numerous rate hikes this year. That was expected by markets already. Potentially as much as 7 throughout the course of the year. Now, that will have widespread implications for financial markets. We look at things like that. I think the main focus around that is, or coming out of that, has been the yield curve. Now, if we have a jump across to this, this is a chart, the spread between the 10-year yield and the 2-year yield. Now, this has been trending lower since last year. Since March of last year, this has been trending lower, but it really has accelerated over the course of this year. And the sort of fear around the monetary policy settings, the amount of rate hikes that we are going to see throughout this year out of the Fed. I mean, historically, an inverted yield curve has been viewed as an indicator of a potential economic recession. When short-term interest rates exceed long-term interest rates, market sentiment does then suggest that the long-term outlook is poor, and that yields offered by longer-term bonds will continue to fall. So that's something we need to look at going forward. The implications, of that can be widespread across markets. If the bond markets feel that there is an impending recession. The thing about the bond markets is people who trade bond markets, they're some of the most sophisticated investors in financial markets. So if anybody knows what's going on, you would probably back the bond market. So we can see here the spread between the 10-year yield and the 2-year yield is at 0.2. Now, if this was to drop further, if this would drop further down towards a 0% level, and the yield on the 10-year yield was to drop below what the yield is on the 2-year yield, that does not prove positive for the economy going forward and can result in a recession at some point in the future. Having said that, looking towards the S&P, which we can see, if I bring this back to the 1-hour chart, we can see this move higher. It's just seemed not really to care about the amount of rate hikes that the Fed were talking about, which is pretty significant in my opinion. I mean, it shows a blatant disregard for the tail risks in markets at the moment. With rising interest rates in America, with the Russia and Ukraine situation potentially being prolonged or may even escalate, and also the rising prices of commodities potentially causing sustained inflation going forward. It's really something markets need to think about, and they've kind of disregarded it this week when it comes to the Fed, which is interesting. But I also think markets are slightly disregarding the tail risks around this. But we've been saying that the last 2 years, and for a good chunk of that 2 years, markets have trucked on higher. It's a little bit different now, though. We are raising interest rates, removes monetary stimulus. So it's not an easy buy as it used to be. We need to be careful going forward. We need to follow markets, see what they're doing on a day-to-day basis, and work with these trends. And if this continues higher, I think we can keep buying it in the short term, but we do need to be careful long term about the implications of a potential inverted yield curve. Now, as we come across the cable and we have a look towards cable, with the Bank of England out yesterday, we had the Bank of England with their rate hikes. Came in for the third consecutive meeting, hiking interest rates. Unlike the Fed, who hiked their interest rates for the first time in 3 years. Yesterday, the Bank of England are the first central bank to get back to pre-pandemic levels of interest rates. They are back at 0.75%, a 25 basis point rate hike. But markets viewed this statement here, that the vote for the rate hikes, they expected for all 9 members to unanimously agree on a rate hike, but we did see one member dissent and one member voted for unchanged. So that was seen as a bit of a dovish stance. The Bank of England were predicted to hike interest rates numerous times this year, potentially 5 or 6. I was reading that markets had priced in 5 rate hikes over the course of this year, and now they say the outlook is a little bit clouded. They are unsure as to whether they're going to continue hiking interest rates throughout the rest of this year. So potentially we might get one more rate hike in the summer of this year, and then maybe not see any more till next year. So have to see how that plays out at their upcoming meetings. They were mentioning inflation. They did mention inflation. Bank of England's governor Andrew Bailey said he hopes high inflation will cool down inflation. The fact that inflation is so high may cause a drag on economic growth, and that in itself may cool down inflation. So it remains to be seen how that plays out going forward. Still a bit difficult to predict what happens going forward. We don't really know how this Russia and Ukraine situation is going to escalate, if it does escalate, and if it does escalate further, and that itself can cool down inflation, maybe we don't need all the interest rate hikes. But if commodities continue to rise in value, that can cause sustained levels of inflation. And if we have sustained levels of inflation and increased levels of inflation on top of the inflation levels we already have, that could prove a mess, an absolute mess for these central banks. So, in terms of what my personal predictions going forward, I'm slightly undecided. There's a couple of different options we can take. We need to keep up with the rhetoric. We need to keep up with markets, up with the charts, and see what happens going forward. We can't really make any decisions as to what we feel. I think we need to wait. We need to see what this Russia and Ukraine situation does. Does it escalate and cause economic damage? Or does it and the economic damage itself cools down the likes of inflation? Or do the rising commodity prices, do they keep rising, and does that cause further inflation? It remains to be seen how that plays out over the coming weeks and months. We come across the next week. If this wants to load for me, we come across the next week. We have a relatively quiet economic calendar. We have a speech out of Jerome Powell. I think any of his speech, personally, I think any of his speeches going forward will be widely looked at by markets, and that will be probably the main focus of attention next week. We've got the PBOC with their interest rate decision, but I think markets will probably look towards Jerome Powell's comments for further monetary policy adjustments and information. So pretty quiet calendar next week. That can mean a couple of things. That can mean that we get slow markets for the duration of the week, or we can get some good markets where we can work off cross asset correlations, and we can work off our technicals. Otherwise we may potentially be in for a boring week next week. So we'll see how that plays out. We'll keep an eye. Quiet economic calendar can go one of two ways, but we will be sure to update next week at the same time for another weekly market insights. So have a good weekend. That's all from us, and I will speak to you next week. Have a good one.